Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. Today is Thursday, October the 21st, 2010, and like we do every night, it's time to look at the markets. Check this out. Okay, before we get started, I want to point out the Russell 2000 Small Cap Index to you. This is a 6-year chart, I believe. Basically, back here when we started shorting this guy, we were brought up some fundamental points on this market, and she's getting overly extended again. So I want to bring these points up again for those people who are new following us. A lot of you guys weren't following us back here when we were shorting. So let's cover this again. First off, at PerfectStockAlert.com, we do both fundamentals and technicals. We apply and meld them together and conclude, whatever we see on one, we expect to see on the other. And they should work together. They should be both signaling the same thing. And right now, we're getting lots of technical sell signals, and we should be seeing the same thing on a fundamental standpoint. And of course, we are. We got a really easy ability to do that with this one. Let me give you a really simple rundown here. This is 2006 time period, right? Here you are. Okay, let's assume for a moment that this black box indicates the fundamental economy we believed we had at this time period, which substantiated this price activity. Okay, this was supported by a perceived fundamental market that we had at this time. First off, this is a lofty view at this time. In '07, we got even loftier. We believed that we had an economy that substantiated like this based on the potential for our companies and the earnings, so forth and so on. In reality, we know in hindsight that, yeah, that wasn't actually accurate. And what really ended up happening was we realized we were in a real estate bubble that burst. So down we started falling, right? Okay, we all know the story. So you have, home prices went from being about $240,000 to about 175 right now. So you've lost about 65,000 dollars in home value, and that's a good chunk of change to see, and that's a lot of your consumers' ability to buy right there. They're taking a lot of loans on their home values and so forth and so on to do all their spending beyond their means. 401k values are a lot less. Let's see, the dollar's value is a lot less, and that's important to the consumer because the majority of what we buy is not made here in the U.S. So if our value is worth less, it doesn't go as far. Things become more expensive for us to acquire. Now that's important when you look at the fact that our U.S. economy is 70% driven by consumerism. So if consumers don't have the money they used to have, their home values are worth less, their 401ks are worth less, their earnings are worth less. Whatever your dollar is, if it's worth less, you can't buy as much stuff at Walmart, right? All right, so the reality is, at the end of the day, we don't have this economy anymore, all right? So why then would we trade up to that level? We don't have an economy of this size to support prices at this level and higher. Okay, think about it. Back in 2006 and 2007, unemployment was 4.6%. We're more than double that now. So if 70% of our economy is consumer based, and half of those consumers are I'm not sorry, not half, but twice the amount of consumers are now unemployed, that's not going to be a reason to increase the economic fundamental structure here that supports these prices. That would decrease it. So let's redraw it. Okay, we got home prices. See, everything was assumed to be there. Now we know, wait a minute, that's not quite right. Home prices got to be smaller. Let me clear that up. Home prices have got to be less now than they were. So here you were. Okay, and you got to decrease that for the new home values there. All right, well, 2008 kind of did that. All right, you got to take away for the unemployment rate. Well, that's a lot because you're basing the whole thing on consumerism. All right, it's down some more. You're going to have to factor in the fact that your taxes are going to soar thanks to the government we have in play there. Okay, so we're not coming anywhere near to reality by trading up here at almost 2008 highs. Okay, and 2007 lows. Not at all realistic in a fundamental standpoint. All right, the S&P, Robert Shiller's S&P 500 PE ratios, 2007, you're looking at 27.2. Today we're at 21.5. Are we anywhere close to having the same economy we had in '07? Then why are we trading like we are? That's the simple fundamental review, okay? Pretty cool. Let's look at the markets. Okay, a quick look here at the FTSE. She's pressed higher today, making a whole lot of banana sense right there. Again, same signal we've seen before. See this bearish divergence formation here and here. Let's take a bigger picture at the longer term. Okay, that bearish divergence I keep pointing out right here, that should be problematic to you simply because you've seen it before here and here. Okay, you notice you're really rallied off of this point here, same point here. All right, whenever you rally up here and you get overextended and you start getting a bearish divergence back here, that's prior to your big old crash right there before Greece and Portugal and all that stuff came into play. This time we're rallying up here again, exact same situation, same signals, and the same problems over there in Europe still going on. You still got Portugal, Spain, Ireland, etc., etc. So no reason to be a buyer here whatsoever. Okay, quick look here at the gold chart, 6-month daily chart. You'll notice we formed a bearish box here. It moved to the downside here. Bulls try to come back. Bears kick them back down. This basically locks in this point for bears right there. And this is the short-term chart. Notice you don't even want to consider any buy or bounce opportunity until the slow stotch pulls back down below the 20 line. Until that happens, like you had back here, you don't want to even consider it. All right. So wait for that to happen. But also take a look at your longer-term chart. Here we are looking at the long-term chart for gold. You'll notice back here you've got a high point right there, all right, and now this high point here. These high points are lower than the previous, so a downtrend, all right. This point here and here, this shows a bearish divergence right there. You've seen this before, right here, and here, right here and here, right here and here, all right. Your pullbacks could be bigger than you think they're going to be, so be cautious. Don't think for any moment that you don't have to worry about technicals of the gold or anything else, because the Fed's going to do whatever it's going to do, because bottom line, the Fed is a short-term booster shot to the market. Once that news has been played, the game's over. All right, you need to focus, stay true to your what works, technicals and fundamentals. Don't ignore those two. It's never different. It's never not to be bothered with. I've know there's been news articles out there talking about how fundamentals don't apply now and technicals don't apply now. Look, they always apply. Maybe short term you can fight them, but at the end of the day, you're going to always go back to the facts. And the facts are buy and sell pressure and fundamentals, what really drives companies, what really drives economies. Okay, very simple, very easy. If you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free. All we ask in return, please refer a friend. Lots of cool stuff over there for everybody. We've got a new video up there today as well. You can check that out and join us for our swing trading course. You can learn all kinds of stuff there about how to spot quality long and short opportunities. All right, very cool. A big difference between the two. You need to know what you're doing if you're going to be doing anything at all. All right, a quick look at our disclaimer. The disclaimer. Read it and wait. Be sure you check out the MPT rating for tomorrow. God bless, take care, and I will see you all in the next video.